Hello and welcome back. You're watching Market on ET now. Well, we're seeing a nice uptick with 14,500 on the cards for the Nifty. The Sensex is as well packing in quite a punch right there. But now let's introduce on the show on our corporate earnings sector, the management of CEAT. What a great set of numbers. Top line growth of 26%, stellar margin expansion. It has translated quite sizably into a bottom line growth as well. In fact, we have seen the profit after tax almost double, more than double, from 52 crores to 132 crores. Kumar Subbiah, who is the CFO of CEAT Tyres, now joins us on the show. Thank you so much and a very good morning, Mr. Subbiah. Stellar numbers yet again, so congratulations on that. Now, I think the last time we spoke, you had mentioned that there perhaps may be some moderation in the second half, at least for the replacement segment. Do you think that this buoyancy has sort of sustained and even beaten your expectations?
Yeah, good morning. Thanks for having me on your show. You're right. Last time when we had a conversation, we were unsure in terms of whether the demand would sustain, whether it was pent-up demand or whether it was real demand. Okay, and to some extent, we are also pleasantly surprised in terms of demand sustaining throughout Q3. And we see demand sustaining in the coming months too, okay, particularly in the replacement market. That's the way we see the market.
So, Mr. Subbiah, how far do you think you are from reaching that industry peak that we had seen, which was, I think, roughly about 2 odd years ago?
As far as we are concerned, I think we had the best quarter in terms of revenues for Q3, and even Q2 was also the best revenue. As far as we are concerned, as we have added capacities, okay, and if the demand sustains at the current level, it will help us to utilize the capacities. And overall, on account of various factors, economy picking up, okay, and some restrictions in the import of tires, and third thing, people preferring personal mobility and therefore more passenger vehicles on the road. All this, I think, would help the demand to sustain in the Q4, and beyond that, we will have to wait and watch. But we see this sustaining in Q4. And not sure whether it has peaked yet, early to say, but I think we'd like to wait for a quarter to, understand whether this demand is going to grow further. And that's where we would like to read the market. We'll take one quarter at a time as of now.
Large part of the margin expansion, some would also attribute, was a function of cost cutting. But as economy normalizes, travel will start, advertising will start. The squeeze which every company did, your company, my company, the other fellow peers we speak to, some of the costs will start normalizing. How will that pan out for CEAT now?
We exercised very strong cost control in Q1 when things were looking very uncertain and when the demand was looking weak, when all our factories were shut. We started relaxing from Q2 onwards, and it gave us an opportunity to look at costs very differently. Okay. And if you really look at our Q2 as well as Q3 costs, wherever we saw costs required for us to grow, for us to reach to the customers, we stopped exercising controls on such essential costs. What we have cut so far is only discretionary, non-essential costs. In fact, in Q2 and Q3, our advertisement costs shot up significantly because we thought it was important for us to do so. If your question is that, is this sustainable? I think once the normalcy returns, maybe some of the costs like travel costs, some conference-related expenses could certainly go up. As our revenue is also increasing, our ability to absorb any of those increase in costs is certainly there. So we do not expect when the normalcy returns to hit our margins significantly on account of costs. I'm talking about non-material costs.
Given that government now is putting a lot of import restrictions and duty restrictions, I understand that in the past also the tire industry has suffered because of dumping from Chinese tires. Do you expect some incremental changes there? Because now the focus is Atmanirbhar, PLI schemes are getting rolled out. Will that change a lot for the tire industry, or has anything changed at all materially on that front?
It has changed. It has changed for the in a very positive way. Tire industry always suffered on account of inverted duty structure. Okay, our raw materials continue to attract a very high rate of duties. Natural rubber is 27% duty. Many of our raw materials attract not only normal customs duty but also safeguard duties, anti-dumping duties. Whereas the tires were coming into India at a concessional rate of duty in the range of 6 to 8%. So therefore, it was not a level playing field before the restrictions came. Even now, government has not increased any import duties. Okay, only condition that they have now put is that the importer will have to obtain a license to import tires. Otherwise, the duty incidence has not gone up. For your second part of the question, I think it will really help. Okay, Indian tire companies are capable of producing best-in-class tires, as we also import large quantities of tires to reputed automobile manufacturers outside India. Okay, and therefore our ability to meet all the demand within India in general is good. So it's going to be good. One, and number two, unlike other industries, okay, India doesn't have any disadvantage of manufacturing tires on a global scale and exporting it to other parts of the world. Natural rubber, more than 50% of India's requirement is locally produced and sourced, and various other raw materials like carbon black, synthetic rubber, all these are locally available rubber chemicals. So India is cost competitive, okay, and any incentive by the government to manufacture more in India, not only for India's market, but also for international market, I think would be seen very positive. And I'm sure we, CEAT, would certainly take advantage of it and make sure that, the new capacities that we have created, some portion of it is for exports, we would certainly be able to utilize it. I think it's good.
One thought which I'm getting from auto companies is that now after the COVID, they are looking at increasing their whole concept of just in time. And just for the benefit of our viewers, I want to explain this point here. Companies like Hero Honda or Hero Motocorp, they follow a zero inventory policy, which is that when the bike is getting assembled, everything from raw material to tires, they come just in time. Do you see that changing? And if that changes, then we could be looking at different inventory levels for everybody.
Okay, this is more or less already there today. Okay, most of our automobile manufacturers, okay, they manage inventory very tightly. Okay, and when they allocate business and when they work with various vendors, okay, they do take into consideration the ability of those vendors like us to meet those requirements. We do take some special care in terms of ensuring that their daily requirements, shift-wise requirements are completely met. Okay, our supply chain is geared up to meet such requirements. Any additional requirement from the customers would be certainly met by CEAT as well, because we are highly a customer-oriented or customer-focused organization. We don't see that impacting us. Sometimes there are learnings from our own customers in terms of how do they manage inventory, and that helps us to fine-tune our own supply chain. So I don't expect it to have any adverse impact. In fact, it would be a competitive advantage for us because we have a lean supply chain structure where we try to produce what was sold yesterday, and we try to meet the market based on their daily requirement, weekly requirement. So it's an advantage for us.
Mr. Subbiah, hi there, good morning. You spoke about your cost controls as well as a number of steps that the company has taken. So in light of this, just give us a sense as to, how far you are now from reaching the peak of the industry that we witnessed 2 years ago.
I think if you go by last 2 quarters in terms of growth percentage, possibly we are already at that stage or even higher than where we were 2 years back. I'm talking about industry and also CEAT in general. For example, in Q2, our top line growth was upwards of 14%, largely driven by volumes. And in Q3, we've grown by about 27% on top line, and largely contributed by volumes. So strong double-digit growth. I can't remember 2 years back whether we had grown upwards of 20% in those periods. I would say that I think as a percentage of growth, we are even better than where we were a couple of years back.
Okay. And give us a sense as to what is going to be a sustainable margin range for the company in light of the changing mix, the raw material trends as well?
Normally, we don't give any forward-looking statement on margins. But however, I would like to briefly take you through in terms of how our margins have been in the last 4 or 5 quarters. Quarter 4 of last financial year, we ended up at little higher than 12%, and overall average for the previous financial year was around 10.5, 10.6%. Even in quarter 1, when we were disturbed on account of COVID, where the operations, we didn't have any operations in the month of April, all the factories were shut. Even at a lower level, we still reported a margin closer to about 9%. In the last 2 quarters, our standalone margins has been in the range of around 14.7%, and consolidated little higher than 15%. So in the last 3-4 years, we have been operating within a range, okay, maybe 11% plus or minus a percentage or percentage and a half is the level which we have been operating. In the last 3 or 4 quarters, we have reported higher level of margins. Since scale plays an important role for margins, any strong growth, it certainly helps in terms of incremental revenue contributing to margins going up substantially, not substantially, significantly. So the fact that we have grown in the last 2 quarters handsomely at 14% in quarter 2 and around 27% in quarter 3, that scale has really helped in terms of distributing the fixed cost over a larger revenue. We hope we are able to sustain a healthy margin. However, I also would like to mention here, in the last 2 months, the raw material prices have gone up. The raw material costs had gone down in the quarter 1 and quarter 2 of the last financial year. The beginning of quarter 3 onwards, it started going up. Okay, and so therefore, it could have some impact on our margins in quarter 4. Unless and otherwise we are able to mitigate it through some price increase. We have taken some small price increase recently, effective 1st of December, a small increase, and a small increase from 1st of January. But that is not adequate to absorb all the increase in raw material costs. So we'll have to see in terms of quarter 4, considering that the raw material costs have gone up, we need to mitigate to some extent through price increase. In the event that doesn't happen, it will have some impact on margins.
All right, Mr. Subbiah, we'll let you go on that note. Appreciate your time. Thanks very much for giving us a clearer picture as to what the situation is like and what really has driven this growth. The stock price of CEAT firmly in the green, 2.7% at 1309. With news that we're at 14,577, we'll take a quick break right here on the show. Stay with us as we discuss the pre-budget tax recommendation when we return.